I'd like to welcome a former Trump transition economic advisor and current U.S. Executive Director of European Bank for Reconstruction Development, Dr. Judy Shelton. Judy, thank you for joining me this morning.
Thanks for having me, Rick.
All right. Well, I am sure you're aware of all the talk and all the activity really since October regarding not only domestic markets, but global markets. What do you see as the several largest reasons why there's so much volatility and nervousness with regard to markets?
Well, Rick, my first job out of college was as a stockbroker. So I kind of learned a long time ago that markets can be very unpredictable, and anyone who thinks that they can explain why they're going one direction versus another is probably faking it a little bit. I think that there is a serious disconnect between the behavior of financial markets and the underlying real economy, which I think is in pretty good shape, especially in the United States. So the market is just in a mood to amplify every rumor, every conjecture. It's just super sensitive right now.
You know, and also some obvious things that maybe we should underscore more than we do in the media, and that is the machines have really moved as a big vehicle for markets. Many believe a significant percentage now done by machines with regard to trade and movement of capital. They've never really had to take a bear market or the beginning of a bear market or a large correction. But the biggest reason, a simple saying, a chain only as strong as its weakest link. I looked at Japan policy from their central bank. I look at what's going on with the slowing of China. I look at the reverse of global growth. These are big looming issues, are they not?
They are big looming issues. I think the automatic trades are exacerbating the extremes. We're seeing the effects of reversing the quantitative easing. And we knew it was going to be a little bit tricky. You reap what you sow. And when you expand the money supply, you're going to push up markets. You're trying to create the illusion of wealth. It can go the other way when you're trying to then bring it back down to some kind of a normalization. It's very difficult to normalize when you've had such a distorting effect on the economy.
Now, I believe, along with many and some great research by Jim Bianco, that the cumulative stimulative effects of all central banks reached a tipping point in early October. We also see that the Bank of Japan owns close to 80% of their own ETF structures in Japan, and not to mention other assets that they own. We see that the Europeans still have negative interest rates along with the Japanese. Couldn't the market also be nervous not only about general policy, but all the tidal waves the reversal of those policies ultimately send?
Well, that's been a real negative consequence of this whole exercise in monetary expansion. It has elevated the role of government into the private sector. And I think even now, the fact that the market just hangs on the most subtle, nuanced statement from a central banker just tells you that we've turned the handful of people who have some influence over interest rates into something like the Wizard of Oz, the great and powerful. And it distracts us from the fact that the economy is so much more than that. The real economy is people working, and it's a creativity. And there's so many good things that are helping the real economy, like the lower taxes and the less regulation. We just need stable money, and I think that free enterprise would just cultivate and unleash all of the entrepreneurial zeal that is still out there, and we're already seeing it in a strong growth rate. So we just can't be distracted by the shenanigans in financial markets.
Judy, thank you so much for your thoughts. I've remembered many times in the past where Wall Street felt one way and Main Street felt another. I can't wait to see the retail sales for the holiday season. Thank you again.
They'll be good.
Sarah. Yes.